what's happening on home prices as we go into the next segment, which is where I'm going to have a discussion about some feedback we got on our program from last week when we did a pretty extensive discussion about temporary interest rate buydowns. And of course, that was the here's a slide that was on our program last week. Wait and hope for lower rates. What tools can you use now to leverage what's going on right now? Is now a buyer's market? And if so, what are your options? So I discussed this in detail last week with a particular emphasis on what I believe is a great tool to use to leverage the current market and current conditions, and that was temporary buydowns. And what's interesting is I got a reply from a particular viewer that I thought was really interesting, and so I want to address it and talk about it today. And in fact, here I entitled our discussion at the top there. Are interest rate buydowns the bomb, which is what I like to say? They're a great idea. Buydowns are the bomb. Or are they a short-term game of gambling and stupidity? Now, that's obviously some strong language, but I've got a thick skin. I don't take that personally. I think it is a valid interpretation that someone in the general public, a consumer, might conclude from my discussions from last week. And so I want to go ahead and share with you what this viewer, how they commented about my program last week and the points I was trying to raise. Here's one of the two messages that this person sent us. Here, this person says, the biggest concern is not short-term cash flow. It is long-term sustainable and predictable ability to afford the home without stretching, with lower maintenance, tax, and insurance costs, and an opportunity for appreciation. Low prices and tax-deductible higher interest rates are what do that. That's interesting. Higher. We'll come back to that. Not trying to squeeze every last drop of blood out of the rock that these overpriced homes and games of short-term buydowns provide. Get real. Now, I will tell you, this viewer did put a happy face right after get real. So I did take the comments as critical input, but friendly critical input. Now, let me share with you the other comment this person made about our presentation last week. What happens if bondholders force mortgage rates to go higher? Not only will you be stuck with higher rates, you'll also be stuck with a lower home price. We are getting cheaper prices in many cities, especially ones that went up the most, like in Florida and Texas. Pushing home ownership at extremes that only become somewhat affordable if interest rates go down substantially on leverage is called gambling and stupidity. So therefore, that's why I've got in our title of this part of the discussion those adjectives about the idea of temporary buydowns. So let me go ahead and respond to some of these points, several of the points that this person did provide to us. And again, I appreciate this input and this perspective, but I think it's worthy of addressing some of these points because I think to some degree, nothing personal, I think this viewer maybe had misses a few of the points in my discussion about buydowns and why I think they're a great idea. So with that, I'm going to go ahead and give you some of my input. First of all, in terms of this viewer's obvious interpretation is that I'm pushing home ownership, that I'm somehow suggesting by using temporary buydowns that I might be trying to push people, families into the idea of buying a home when maybe they don't have any business buying a home at this point, either because of their ability to qualify or because the conditions aren't good enough to justify buying a home. But I want to first underscore a very important point. This is not what buydowns are for. It's not about pushing home ownership. In my comments where I've been telling people, if you've been on the sidelines waiting for lower rates, and why I think that's a fool's game, because we obviously haven't seen rates fall in a significant manner. If that's what you've been waiting for, I do suggest not to do that. And instead, if you are eligible and able to qualify for mortgage financing, I do think it's a good time to get off the sidelines and buy. But in doing so, understand that buydowns are, I think, a better tool for those of you who choose to get into the game and buy a home now, either because you have significant need to buy a home, because you need better housing, maybe you need to get out of an apartment where you're squeezed with a growing family, maybe you have to buy a home because of the fact you're facing a job relocation, you're going to move from one market or one city or one state to another. In those circumstances, that's not a case of me pushing you to buy a home. What I'm suggesting is if you're going to be entering the home buying market, consider a buy down a tool to use that I think will be a better financial tool for you. Now, remember, just last week, I think it was, we mentioned that existing home sales were at a 14-year low. But that also meant 3.84 million purchases occurred. There's obviously people buying homes out there. So again, my message is I'm not trying to push you to use a buy down to get into a home you otherwise couldn't afford. I'm suggesting if you're going to buy a home, and if you're able to qualify at current mortgage rates, a buy down is a better tool to use than just simply asking for a lower price in your offer. The other thing that this viewer mentioned is, bondholders forcing mortgage rates higher. I put there a question mark. I think that's a little off the mark. Not really. It's not bondholders who control mortgage rates. What it is, it's economic activity, it's inflation, it's deficit spending, and how bondholders, bond investors interpret that data and react to financial conditions. So again, bondholders are reacting to these conditions. They're not creating these conditions. And you have to understand that if you're going to hold bonds, if you're going to invest in bonds, and remember, as I've said many times, most mortgages in this country serve as collateral for bonds. So bondholders may change their perspective on the market based on all these economic variables. And as a consequence, certain economic data is going to cause bond yields and therefore mortgage rates to go higher. But it's not the bondholder themselves that are causing that phenomenon. It's the data and how they're interpreting it and how it's going to affect their investment in bonds. So I think that's a vital point to understand. The other thing that this viewer indicated or suggests is that higher rates are going to push home prices lower. So if you buy a home at these rate levels and home prices fall, then or if home prices go up, that you're going to see your home appreciation drop. Well, guess what? I have news for you. As we've talked about for the last year or two, that hasn't happened in the last couple of years. Mortgage rates are more than double what they were in 2020 and 2021. Did those higher rates cause home prices to fall? I don't think so. And I think the data is overwhelming that it did not. And in fact, as we just mentioned with the Case-Shiller's index, home prices continue to go up. Now, they are going up at a slower pace overall, true. And yes, it's true in some markets, there is some modest price decreases. But generally speaking, overall, the higher rates that we've experienced the last couple of years has not caused a significant drop in home prices. So I think that theory is a little bit unfounded based on most recent conditions that we've all seen and experienced. Now, the viewer goes on to say that the goal of home ownership should be long-term, sustainable, predictable ability to afford a home without stretching, with lower property-related costs and opportunity for appreciation. Low prices and tax-deductible higher rates do that. And I put a there, which I'll come back to. And again, in fact, yes and no. Buy downs, I do believe, are a tool in alignment with most of this goal as stated by our viewer. However, I would argue, in fact, I say it's arguable that tax-deductible higher interest rates are beneficial. That reminds me of a notion that I first encountered when I first got into the business out of college over 4 decades ago. I can remember certain borrowers, even realtors representing buyers, would say, yeah, my client wants to get as big of a loan as they can at the highest rate they can because they want that mortgage interest deduction. If they've got a bigger loan amount, put less in down payment, they're going to enjoy a much greater amount of tax deductibility of the mortgage interest. Well, that's true, but I think that's a little bit flawed thinking. Why? Because when you take a higher mortgage amount or you accept a higher mortgage rate, is that really beneficial because of the higher amount of interest you get to deduct? I would argue no. Why? Because, as I put in the slide, cash flow is still king. Remember, even at a higher tax bracket, 25, 30, 35, 39% tax bracket, if you're going to take a higher loan amount because of the tax deductibility, you're only going to get to write off about a fourth, maybe a third of that higher payment that results from the higher mortgage amount or rate. you don't get deductibility for the entire amount of that higher payment, only a quarter to a third. So what you're forgetting is the cash flow impact of taking that higher loan amount or that higher interest rate. So I think the idea of doing that just because of the tax deductibility is a little bit flawed. And then the last point that the viewer made, or the other pretty strong point the viewer made, squeeze blood out of a rock from overpriced home and games of short-term buydowns, or the game of a short-term buydown is called gambling and stupidity. This perspective misses a fundamental feature, I should say, of buydowns. They are not a qualifying tool. I have never suggested that you should use a temporary buydown, whether a 3-2-1 or a 2-1, to help you qualify for a mortgage amount or a home price level that you otherwise could not afford. And why is that? What is the unique feature of a buydown that avoids that situation? Very simple. Buydowns do not and never have allowed the buyer, the borrower, to qualify at the first year rate. That's never been the case. Even 4 decades ago, when I was arranging temporary buydowns for buyers of new homes in LA County, in the Antelope Valley, Palmdale, Lancaster area in the late 80s, we did not use temporary buydowns to qualify people who otherwise couldn't afford the mortgage amount, the home price, or the monthly payment. Again, it's a way to improve the cash flow to that buyer over that interim or that initial 2 to 3 years, but they're still going to be qualified. We're going to determine their ability to repay, not on that first year rate in the 3s or the 4s, but in that note rate in the mid 6s. And so if we can establish the buyer has adequate income, manageable debt levels, and a decent credit score, and they meet a reasonable debt to income ratio that might be in the high 30s to low 40s, we've established that that home buyer, that borrower, is not going to face financial difficulty at the end of the buydown period, whether it's 3 years going from the 3s to the 6s or 2 years going from the 4s to the 6s. They're being qualified up front at the 6% mid 6 level. And so again, this is a tool for someone who otherwise is able to qualify in today's current conditions. They're choosing not to because they don't like that cash flow impact of that high mortgage payment, even though on paper we can establish very clearly they can qualify that based on our current ATR rules, ability to repay. Those rules have been in place since 2010 by the creation of the CFPB. Those rules have been incredibly helpful to ensure that we don't have a repeat of the early 2000s, mid 2000s that led up to the crash of 08, when the ability to repay rules were not in place and home buyers, through mortgage programs, creative ones that were frankly gambling and a reflection of stupidity, were allowing people to get into home prices and loan amounts and interest rates that they could not afford. Yes, the mortgage industry unfortunately had poorly designed loan products back then that created that environment. That's gone. That's been gone since 2010. The ATR rules ensure that even if we use a temporary buydown, that borrower is going to qualify not on the first year rate, they're going to qualify at that note rate. So when they finish that buydown period, they should still be comfortably able to handle that note rate payment going forward from there if they still have that loan and have not refinanced it since then. So I wanted to make that point. I think it's a very crucial point in understanding why I do think temporary buydowns are a great tool. If you're going to enter the market now, or you're contemplating it, and if you talk to somebody like us where we can establish you can qualify at today's rates in the mid 6s, I would urge you to consider get into the market, use the buydown to give you that payment flexibility, that payment improvement for the first 2 to 3 years, because we're going to show you that you'll still be okay when the buydown period's over. But in the meantime, it buys you that 2 to 3 year window for when rates do fall, and they are still expected to fall. It's just going to take longer than we thought. Then you have that opportunity to refinance into a lower note rate, lower than what we already determined you can qualify for. And that way it should be a safe environment for you either way. And of course, when rates do fall, I would argue more home prices are going to go up further, or that slowing rate of appreciation is going to accelerate or start to accelerate again, and home prices are going to go up maybe faster than they are currently. They're certainly not going to fall. So hopefully that input from me in response to this viewer's input, I hope makes it more clear why I think overall the temporary buy down strategy is a good one, worthy of consideration, again, either for a home buyer who is already in the market and needs or wants to buy, or somebody who's on the fence, who's been waiting for those low rates. I don't think you should wait any longer. Get into the game now. We'll help you make sure you're going to be okay at that mid 6% level, but then show you how using the buy down instead of just offering a low price is going to be much more beneficial to you financially. Okay, well, I want to thank the viewer for that input. I think it was helpful to provide a response to that input, so everyone who's watching this has a better idea of the pros and cons and the idea of temporary buy downs as a useful financial tool when you're buying a home.